Massachusetts, United States. In a region long recognized as a hub for tissue engineering and regenerative medicine, a company that once led the industry for nearly 3 decades is now quietly cutting off its core business lines. That company is Organogenesis Holdings. This is not just another biotech company. Organogenesis Holdings has developed bioengineered skin substitutes designed to treat chronic and hard-to-heal wounds, such as diabetic foot ulcers and venous leg ulcers. These products, approved through rigorous clinical trials by the U.S. Food and Drug Administration, have been used in thousands of medical cases and have long enjoyed reimbursement support from both Medicare and private insurers. The flagship products, Apligraf and Dermagraft, were respectively approved in 1998 and 2001 and have since been widely recognized in the healthcare community. However, in the summer of 2025, the company's earnings report released after market close raised serious questions among investors. Total revenue dropped nearly 25% year over year, and most notably, sales from wound care products, once the company's strongest revenue driver, declined dramatically. In stark contrast, the surgical and sports medicine segments showed strong double-digit growth. Such a divergence within the same product portfolio is highly unusual. In general, variations in product revenue are explained by new product releases, competition, supply chain issues, or seasonal demand. But in the case of Organogenesis Holdings, these factors don't apply. The products are based on the same platform, developed under the same infrastructure, and managed by the same teams. Yet, they are experiencing polar opposite outcomes. This rare phenomenon signals a deeper and more structural mystery. The underlying cause appears to be the Medicare reimbursement policy revision announced on November 14, 2024. On that day, 7 Medicare administrative contractors, MACs, simultaneously released a final policy update that redefined reimbursement eligibility for skin substitutes used in treating diabetic foot and venous leg ulcers. The policy stipulated that products lacking sufficient clinical backing, especially those approved through the FDA's 510(k) process, which requires only technical equivalence rather than full-scale clinical trials, may be excluded or receive limited coverage. Products such as PureApply, PureApply AM, and PureApply MZ fall under this category. While these collagen-based wound care products have shown real-world effectiveness in clinical settings, their pathway to market through the 510(k) mechanism placed them at a disadvantage under the new reimbursement framework. On the other hand, Apligraf and Dermagraft, both of which received pre-market approval, PMA, based on comprehensive clinical trials, remain eligible